Hello, and thank you for watching this quick video tutorial brought to you today by Low VA Rates. We are speaking about the 5/1 ARM loan, also known as the 5/1 adjustable rate mortgage. Some refer to it as the 5/1 hybrid. We're going to go into all of that so that you can better understand it, okay? So, number one, what is an ARM loan? Well, of course, it is not this, okay? An ARM loan, simply put, is an adjustable, there's your A, rate, there's your R, mortgage. So we're not talking about the ARM that we all have. We're talking about an adjustable rate mortgage. Now, adjustable means the interest rate can change. It can go up, it can go down, certainly can't go sideways, but it can go up and down. Normally, an ARM loan starts with a lower rate and a lower payment. The lower the rate, the lower the payment, than a fixed rate mortgage. So, for example, today is November 2nd, 2016. If you were to go and buy a new home today and you negotiated an interest rate on that mortgage, if you took an adjustable rate mortgage, whether that was a 1-year ARM, 3-year ARM, 5-year ARM, you would almost certainly be offered a lower rate on the ARM than you would on the fixed. So let's speak specifically about the 5/1 ARM, because that's what this video is about. A 5/1 ARM has a rate that is fixed for the first 5 years. So just like a 30-year fixed, you are fixed for 5 years. No matter what happens, your rate is not going to change. Now, not only is the rate not going to change, neither will the payment. Nothing changes in the first 5 years of your mortgage. Now, I mentioned on the prior slide, this is also known as a hybrid loan. I like to explain hybrid like this. We've all heard of hybrid cars. What makes a car a hybrid? Well, it runs on gasoline and, generally speaking, some sort of other fuel source. It could be natural gas, it could be electricity, it could be hydrogen, you name it. I've even seen cars that have portions of their fuel coming from the sun. Now, when you take two things and combine them, and the outcome is generally better, then that's how I explain a hybrid. So you've taken fixed rate benefits and adjustable rate benefits, and you've combined them into one, and you have yourself a hybrid loan. Okay? Now, these hybrid loans also aren't just fixed for the first 5 years on the 5/1 ARM, but they can generally also, your interest rate can only adjust one time per year after that fixed term is up. So after year 5, your interest rate just doesn't go up every other day or every other week or even every other month, but generally speaking, it can only adjust one time per year after the first 5 years. So let's talk about the good and the bad, or as we like to call it, the pros and cons. We're going to start with the pros of the 5/1 ARM. You get a lower interest rate and lower payments than you would if you were to get a 30-year fixed. We've already talked about that. That's the main reason people go with an ARM loan. Lower rate, lower payment. You also have the benefit of knowing what your payment's going to be for a defined period of time. On the 5/1 ARM, if you were to buy a home today, you're going to have the exact same rate until the year, let's see, 2021. Did I get that right? It's 2016. Test my math. Add 5 years. You're going to have the benefit and stability of a fixed rate for a predefined period of time. That would be 5 years. Now, this is great for people who plan on moving sometime in the next 5 years. Why would you go take a higher rate simply to get a 30-year fixed mortgage if you know by the time your second child turns 3 or 4, you're going to be moving, or you plan on transferring because you're in the armed services? There's a lot of people that have no intention of ever staying in their mortgage for more than a handful of years. These loans, the 5/1 ARM loan to be exact, is a great option for someone that plans on moving. Now, let's talk about some of the cons. I have an ARM on my home. I've loved ARMs for years, so it's really difficult for me to even call these cons or risks. But let's talk about the ones that generally people think about. Number one, your payment and your rate can change. After year 5 on a 5/1 hybrid, your rate might go down. It might go up, but the fact of the matter is it can change, and that could be perceived as a con or a negative portion or part of the ARM. Also, there is some uncertainty, as I just explained. You don't know if rates are going to go up for the next 10 years straight. They've been going down relatively speaking, if you looked at an interest rate chart since the year 2001, interest rates have been on a downtrend. That means though they bounce up and down like my mouse here, they've been going down. What happens if they were doing this? Well, there could be some uncertainty. It's not as simple. Simply put, pun intended, a 30-year fixed rate is very simple. You buy your home, you get your rate, you get your payment, and, you know, it's pretty simple to follow along. An ARM rate could be perceived as a bit more difficult. Now, VA, as you know, low VA rates, we specifically focus our attention on veterans, but we do conventional, we do FHA, we do USDA, we do every type of loan under the sun. If you haven't served in the military and you are just a civilian, you can still take advantage of FHA loans. These are not just for first-time homeowners or for certain demographics of the country. Everyone can take advantage of an FHA loan. So I want to focus quickly here at the end. The VA and FHA 5-1 ARM are my favorite, and here's why. They have less movement or volatility than your conventional ARM loans. We can get into other videos and other trainings at other times. If you go to our YouTube station for low VA rates or give us a call, we can go into more detail. Just know that there is less volatility in these government-endorsed ARMs as there are conventional. Okay? Why? There's also caps. There's like ceilings. There's floors. There are things to keep your interest rate from skyrocketing during hyperinflation. They cap, VA and FHA cap your interest rate movements every year. It can only happen one time a year. It can only go up 1% a year, and it can never go up more than 5% from where you started. These are caps that have to do with VA and FHA 5-1 ARMs. The index, I talked about the volatility and how much safer these ARMs are than some others. Well, the index that these ARMs are tied to it's a very, very safe index, and that helps add to this stability. And lastly, I have seen on daily rate sheets, and we work with many, many, many lenders and investors across the nation, your VA and FHA ARM rates are, generally speaking, much lower than your conventional rates would be for an ARM product on that same day. So, you know what? Look at the ARM loan. It's a great loan. Thanks for researching. Give us a call at 866-569-8272 or check us out online at lowvarates.com.